let's talk about the balance sheet in your therapy practice. My name is Toni Cameron with TLDR Accounting, and we provide tax and accounting services to therapists in private practice. So, the balance sheet. Last week we talked about the profit and loss statement. Now, the balance sheet is a little bit different than the profit and loss statement. It is one of the main statements that you should have for your practice, whether you're just keeping track of it in Excel or you're using something like QuickBooks. So if you watched our profit and loss statement video, you know that the P&L, it's a picture over time. So it's of 2019 or Q1 or January. The balance sheet is a photograph instead of a video. So it's a snapshot. It's as of 12/31/19. It's as of 8/20/20. It's as of a date, and it's one of the things that makes it very different because it's just one moment in time, and it changes on a day-to-day basis. So the balance sheet, that's one of the biggest things, and one of the biggest things to remember about it. Now, the balance sheet, it's 3 main sections. It has your assets, it has your liabilities, and then it has the equity section. So assets, those are things like your checking account for your business. If you have any inventory for your business, equipment, say you bought computers for your staff, your computers would be listed. Office equipment would be listed. So if you have a giant copier, that would be listed. So those sort of things. The liabilities, now that would be your credit card amount due. Say you have a rewards card and that's what you use for all of your expenses and you owe $1,000 on it. That would be listed under the liabilities section. So it's anything you owe anyone in your business. Same with if you have a loan that's outstanding, all of that would be included under liabilities. Now, the equity section, which is the last section, this is how much you've put into the business and a compilation of how much the business has earned. So it's kind of an investment account to yourself, and it gives you an idea of the resources that the business has had that are yours or are allocated to you. Now, if you're the only owner of your practice, the equity section is much more simpler than if you have, say, a partner and it needs to be split out to be, well, how much did you put in? How much did your partner put in? How much have each of you taken out? And that sort of thing. The big thing to think about with the 3 main sections, and as we mentioned, it's assets, liabilities, and equity, is assets equal your liabilities plus equity, right? So the easy way to think about that is the resources your business has have to equal what you owe people and how much you've invested in the business. It all ties out. It's one of the things when we talk about how your books have to tie, your bookkeeping has to balance. That's because of the balance sheet, and your assets have to equal your liabilities plus your equity. Now, assets. We'll go into this a little bit more in detail. So it would be your checking account, any bank accounts you have, a savings account, any inventory, as I mentioned, anything like that is what's going to go into your asset account. 9 times out of 10, you can touch your assets. So you can touch the cash you have. You can touch the inventory you have in your company, right? Because you're a service company, right? Your assets are really important, right? Because you've got to make sure you have enough cash in your bank account to make your credit card payment, right? That's important. So keeping an eye on what your balance is important. It's one of the reasons why we ask that you do take a look at your bank account each month, and when you reconcile your accounts, that's making sure that all of the transactions from your checking account has been recorded in your profit and loss statement, and it ties back to the balance on your balance sheet, right? It all comes together that way. The only other thing to bring up about the asset section is you can have current assets and non-current assets. What that means is a current asset means it's liquid within a year. So that would be almost everything's a current asset. A non-current asset would be if, say, instead of renting an office, you bought an office building. That would be a non-current asset because you bought the office building. And if you got a mortgage on it, the mortgage would be on the liability section of your balance sheet. which brings us perfectly to liabilities. So the liabilities are what your business owes to other people. So as I mentioned, if you bought an office building, the actual office building would be on the asset side, and then the mortgage on that office building would be a liability. The same goes for your business credit card. The balance on that would be listed on the liability side, and it goes back to that current and non-current. Your credit card balance would be a current liability, and the mortgage, part of that you would pay within the current year, is a current liability. But most of that mortgage would actually be a long-term liability because you're going to pay it over 30 years, right? So that's just one of the things to think about. Then the last section, which is one of the most important sections, and it's one of the things that I make our clients make sure that they're keeping track of, is the equity section. Most people are like, I don't understand the equity section. What does this mean? An easy way to think about that is, say you started your therapy practice with $10,000. Quite a large amount of money, but that's what you put into your business checking account after you opened it. So you'd have cash of $10,000, and then you would have owner's equity of $10,000. They balance out. Now your equity section, it does change over time because there's a couple of things that go into the equity section. So it's money that you put in the business. It's money that you take out of the business. So you put in $10,000. You made your net income for the year was $5,000. That would then increase your equity account. So it went from 10 to 15 because of your net income for the year was 5. And then say you took out $12,000. So that would then leave you with an equity account of $3,000 because it's the amount you put in, which is 10, your net income, which was 5, so that brings you up to 15, and then you took out 12, leaving you with $3,000 in your equity account. Now, when you're just a single member LLC, keeping track of your equity, it isn't a huge deal, right? It's money you took out for that, and no problem. It's once you do become an S corporation, it's much more important because then we need to report that to the IRS. And anytime we got to report something to the IRS, we want to make sure it's correct. So what are some of the things that would be listed under the equity section? So anytime you take money out of the business. So say you took out $1,000 for your federal estimated taxes, that would be listed as a distribution for federal taxes under the equity section. If you took out, $2,000 for the month for your salary, that would be a distribution. Say you put $5,000 in because you were talking about buying that office building and your company needed more money to put a down payment down, that would be part of the owner's equity section, and it would be an investment in your business. So most of the time, the way to think about the equity account is it's what you put in, it's what you took out, and in your net income ends up going in there. So it's an account that keeps track of all of that at any given moment in time. So if we pull the balance sheet as of the end of the year on December 31st, it's going to show us what your equity account is as of December 31st. So the TLDR, your balance sheet is showing you the resources available to your business, any debt it owes, and the ownership interest in the business. Remember, assets equal liabilities plus your equity. If you found this helpful, subscribe.